Hello, everyone. Welcome to another episode of Options Discovery. Today, I'm sitting down with Larry Abrams, the president of Absolute Return Capital Management. Larry, can you tell me a little bit more about yourself and how you got to where you are today?
Sure. I've been in the trading business pretty much my entire career, which spans over 35 years now. Actually, I hate to say it, closer to 40, I might be now. Started out most of my career was on the trading floors. Of course, the trading floors don't really exist at this point, but I was a proprietary trader for over 25 years. Started out at the Philadelphia Stock Exchange with the firm Cooper Neff and Associates. A lot of the younger people today don't know Cooper Neff, but we were one of the probably what I'd call the big four option trading firms and market making firms at the inception of options, starting out in equity options, expanding into options on futures as well. And I traded, as I said, in Philadelphia, moved on to Kansas City and then Chicago with Cooper Neff, ran the Chicago Board of Trade and SIBO operations. And after the firm was acquired by a couple of banks ultimately, but the first tranche was a major Japanese bank. Started my own firm based on the floor of the Chicago Board of Trade, primarily trading in the soybean options pit. Did that for another couple of decades. And then when floor trading really ended, I left the floor and started a commodity trading advisory firm, CTA, called Absolute Return Capital Management, and that's where I am today.
So, as you were saying, I know you spent over 30 years on the floor. What would you say were some of the most influential experiences you had while trading on the floor?
Oh boy, there were so many. Actually, John Lothian, who you work with, John did another podcast series called, I think it was called the Open Outcry Project. I was a guest on that in a two-part series, and I go into a lot of the floor stories there. So, and in fact, there are stories, but influential, it was really more about the raw capitalism, the raw honesty, if you will, of being on the trading floor. It was instantaneous reward and punishment, I guess we'll say. And the most important thing about being on the trading floor was, in fact, having that control of your emotions, being able to be super objective as you traded in what really does appear to an outsider to be just massive chaos. It's actually quite orderly. In a lot of ways, I compare it to many years ago, I was in Tokyo and I was in Shinjuku train station where during rush hour, and I don't speak Japanese. And yet this was massive people running in every single direction with the PA system nonstop or concurrent PA systems in Japanese, and everyone running, looking up at the display boards. This was pre-cell phones and everything. And thinking to myself, how do these people have any idea what they're doing? And of course, it was entirely orderly to them. And that's a lot what the trading floor was like, that it was a unique language and unique culture that others couldn't really understand unless you knew that language, knew that culture. So it was a lot of fun.
It's really interesting to see how you have to, I guess, handle that high intensity environment. So I know you said you're the president of Absolute Return Capital Management. So what lessons did you bring from the trading floor to your current job?
Oh, sure. That's fairly easy for me to answer. It's a systematic approach that's very much rules based, and that's what made me successful as a trader on the floor for all those years. They're in a lot of ways, the trading floors and all trading is kind of a big revolving door of people who come in and come out, and the majority are not successful at it, and it primarily because of a lack of discipline and risk management. Some people just don't understand it, don't get it, but there are a lot of smart people who came to the trading floor, come into trading today, and they still are not successful because they can't, again, separate those emotions and stay within boundaries and stay within a certain set of rules. And whether I was on the floor or I'm trading today, I'm very much of, in fact, a rules-based trader, and risk management is central to everything and overrides everything. So I've continued to, on the floor, I had certain rules. They're not the same rules necessarily. Um, some are, but in a lot of ways, you have to customize yourself to the experience, and yet it's very important to figure out what those rules need to be in order to be successful and to stick with them.
And to kind of piggyback off that earlier
Yep.
question, what advice would you give to someone who's looking to get started in trading?
Yeah, so the path today is a lot different than the path when I started. Um, the trading floors it really was the Wild West in a lot of ways, and it really was, I guess, maybe more akin to sitting down at a poker table than to getting into high finance or into today what is more technology backed. Although some of those the other skills are still very important. I'd say that the days are, there is no trading floor. The beauty of the trading floor was it was open to anybody who wanted to come down and was able, either had or was able to convince somebody to stake them with the capital necessary to either buy or lease a membership. And leasing was not that expensive back then. And the capital, for a trading account. But today, the barrier is lower. Anybody can trade. You can trade in a, you know, almost cost-free environment. There are front ends out there like TD Ameritrade systems and things like that at TD Ameritrade, which is now Schwab. Thinkorswim is their best platform. Costs nothing to use as a non-professional, and the commissions are very low. So anybody can come in, but again, having that infrastructure and knowledge is very difficult. As far as becoming a professional trader, the big difference today is it really is a technology game. And it used to be, again, that my advantage trading on the floor was time and place more than anything. Well, now there's open access to the entire world. And the other thing was, for instance, when I traded in the soybean options pit, there were 200 of us. Or when I was trading in certain pits at the CBOE, there might be 4 or 5 guys standing around, and that was the market. We were the market makers providing the liquidity. But now there are thousands and thousands of screens all over the world, and thousands of participants, both on the buy and sell sides, and the competition is fierce, and everything is about technology. So you have to, if you want to be a professional trader, my advice is you kind of have to go work for a large firm. And if you're working for a large firm, you have to have at least a pretty good understanding of, or have some ability to code and to speak with programmers and speak with the tech department and have that language as well. A lot of the firms have separate divisions of technology versus traders, and yet you need to be able to correspond with one another. So it's a high capital game, and as a professional trader.
I think it's interesting that you brought in coding because some of my business classes are now incorporating coding into the curriculum, which I think is
Right.
a great addition.
It's absolutely essential. It's necessary.
Yeah.
Yep. Yep.
So I want to ask you some questions related to some of the things you've done outside of the options industry. So can
Sure.
you tell me a little bit more about your nonprofit, Open Heart Magic, and what influenced you to start it?
Yeah, so it's actually not my nonprofit. I'm associated with the organization. It's a fantastic nonprofit organization. So yeah, called Open Heart Magic. And what we do at Open Heart Magic is we actually perform bedside magic for children in pediatric hospitals. And it's just a phenomenal way to bring a good experience to kids in the hospital and their parents, families, support systems who are there visiting at any given time, who are really facing difficult times. And generally speaking, nobody's coming through that, or very few people are coming through that hospital door with good news or with fun or enjoyment. It's usually quite the opposite. and we're able to go into these hospital rooms, spend 20 minutes and perform bedside magic, and really change the whole dynamic often of mindset, and I'd like to even think, physical well-being also. I got involved with this organization about 10 years ago, just as a hospital magician. I was on the board for a few years and still am at the hospital every other week performing magic, and have actually, as a byproduct, become a fairly accomplished magician. So that's pretty cool. Magic spills out into other areas of life as well. So we're an organization about 100 and at its peak about 180 magicians. After COVID, I think we're not at 100 yet again, but we are rebuilding, and it's a great organization, which I'm not going to plug it further than that, but openheartmagic.org if you are interested in learning more.
Definitely feel free to plug it. I think it's a really unique way of impacting people's lives. And I know you
100%.
were saying, I guess magic spills into other areas of life. Would you say that there's any other similarities between a magician and an options trader?
There are absolutely. So I was talking about options. I will never stop talking about this systematic approach and the meticulous control regarding risk management, and that, as well as looking for opportunities within markets, finding the inefficiencies. Magic's kind of similar. It's really interesting because, first of all, magic and trading, at least the way that I trade, um, rely a lot on pattern recognition. And in magic, you want to create these patterns and these recognitions. And when you're creating a magic trick or an illusion, a lot of times you'll look for these type of patterns. And in many cases, not if they're not there, if it's not the pattern per se, it's a pattern that a person receiving who's viewing a magic performance will perceive the pattern to be. So a lot of times, they'll expect a certain pattern, and if you can, within your magic trick, not have that pattern happen, it can create that confusion, if you will, that makes the illusion work. In addition to that, again, when constructing a trick, you're looking for layers. You're looking for different layers of complexity, different layers of finding kind of like where that edge is that's going to give you the massive impact on the illusion. And the same thing within trading. And then lastly, the similarity, or there are many more, but another major one is having outs. So a lot of times you're going to make a mistake in a magic trick, and you're going to make a mistake in a trade as well. And you've got to both recognize when that happens and realize how to control the damage of it. What are the ways to, again, manage your risk, turn it into, if possible, even benefit from the mistake, from the unforeseen thing happening. So if you're looking for a certain card within the deck, or you're expecting it to happen, and all of a sudden you turn it over and it's a different one, where can I go with that and still not ruin my performance? And the same thing with the trade. If something unexpected happens that's adverse, what can I do to either capitalize on it or minimize the risk? And so there are a lot of similarities. It's kind of cool.
Well, it was great to hear about all your experiences on the floor, as well as Open Heart Magic, which is the nonprofit you're involved with. But let's get into the main topic of today, which is options on futures, and then we'll also talk about volatility a little bit later today. But
Great.
for those who don't know, can you break down what options on futures are?
Absolutely. So an option on a future, it's actually quite that simple. So there are, I guess I'll differentiate it versus options on other things. You can have an option on anything, and basically what an option does is gives you just that, gives the buyer the option to buy or sell something under certain terms of the terms of the contract. And you can have an option on a physical thing, an option on a piece of real estate, an option on, a ticket to a Bulls game. You can have an option on it, things like that. And then you can have them on stocks and other securities. And then you can have options on futures. So futures contract, so the option is on whatever the underlying product is. So an option on a future is an option to buy or sell a futures contract on whatever the futures contract is. And of course, the same type of variables or the same type of terms apply on almost any option. There's a strike price at which you would buy or sell it. There's a date at which it would expire, so the option's good until a certain date. There's a premium which you would pay for it, and a couple of other things that go into options. We'll probably get into detail with that in a few minutes. But again, it's on the futures contract itself. So let's just use the example of gold. You can actually have options on gold itself, on a gold coin, and you can take that gold coin and you can have an ounce of gold, and the deliverable would be the actual gold itself, or you could have it on a cash settled based on the price of gold, and that's what would settle if the option gets exercised at the end. But in the case of options on futures, it's the actual gold futures contract. So it's the term, that's what you would actually receive if you exercised or were signed an option. I hope that's clear.
Yeah, that is clear. And just to kind of go over some more of the basics, and you were talking about it a little bit earlier, but what goes into making a basic options on futures trade?
Well, so again, in the old days, there was an options pit. There were options and futures pits at the exchange, and you'd have, again, let's just stay with this gold example. There was a futures pit in gold, and there were actually gold traded on several different exchanges. The largest was the COMEX, which was the metals exchange in New York, and since that has since become part of the CME. However, that was where the futures contract traded, and then there was a separate pit that traded options on those futures. And then if you had, in Chicago, you had a corn pit for futures and a corn pit for options. Same thing with bonds and stock indexes in every exchange. Well, now with the exception of Eurodollar options, the trading pits are pretty much gone, and everything has gone electronic. But it's the same type of deal where you have options you have futures contracts listed, and people trade those, and then they have options contracts listed, and you trade those, through the exchange.
And I guess what benefits or opportunities do these kinds of options provide to a trader?
Well, again, and I talk all the time about an option is an option, and it doesn't matter really what the underlying is. Now, there are a couple of very nuanced exceptions to that, but I've always said that, personally as a trader, it was about the financial and mathematical relationships of an option to other options, to the underlying and so forth, and that's where you found the trading edge. That's where the profit and losses came from. Those relationships, and identifying the opportunities and managing the risk of those relationships. I always felt that, and told people, to me, an option is an option. If there was a liquid market in trading paper clips, I'd be happy to trade it, and I would trade paper clip options tomorrow, because it's not about the underlying, and that doesn't really matter. So the opportunities lie, again, in whether, it depends whether you're trading that type of ARB type of trading, which is the relationships, and it's a mathematical game, or if you've got an opinion on the market and you want to take a stance on the market based on whatever it is you're trying to capture, or what your projection is, or what risk you're trying to manage. And there are strategic ways to do that using futures, and there are strategic ways to do it using options, and it really just depends on what your needs and desires are. There are ways in which you can trade options so that you're reducing risk, and there are certain types of option strategies that increase risk exponentially. Generally speaking, long options are less risky than short options. Not even generally speaking, that's just the way it is. And then there are ways in which you can spread options, meaning trading one option versus another, one option versus a group of other options, or a combination that does involve futures or the underlying, that can actually bring reduce to essentially zero. And there's everything in between. And that's where understanding options and equivalent options and relationships between them really is important. On the other hand, sometimes if you've just got a bullish or bearish view, it can be as simple as buying a put or buying a call, and that's as a substitute to buying or selling the future itself.
And I know you're talking a lot about risk here. Can you dig a little bit deeper into some of the risks that traders have to, I guess, consider when trading these kind of options?
Sure. So the largest risk always again lies in being short options, because in short options you have unlimited liability. So in other words, if you were to buy a put option, if you were to buy a put option, well, your liability is limited to the amount that you pay in that premium. But if you sell a put option, your liability is essentially the distance between where the underlying is today and zero. And in some cases more than below zero. A few years ago, crude oil, actually, the futures went to a negative value, a substantially negative value for a short period of time. And people who were short futures or short options that would resemble short futures, could have just had unlimited losses. A lot of people sell options thinking that they're basically collecting the premium, and they are. And the thing about selling short or having short option positions is that they usually make money, because premium, the option premium is in fact is a premium that people pay, and it, often, most of the time, does decay and you make money, but you have unlimited liability when it goes wrong. And that's basically how people get in big trouble trading options.
And I know you were saying earlier, I guess the underlying doesn't matter as much, depending on, I guess, what your goals are. But how liquid is the market, I guess, for options on futures? Is there any difference, I guess, from like the standard stock option?
Yeah, actually, you hit the nail on the head. Nice. It's a great question, because while I say it doesn't really matter what you're trading, when I use that example of paper clips, one thing I said is if there was a liquid market in paper clips, I would trade it. So liquidity is the key to that. The fact is, if you want to trade futures options on S&P futures, you can essentially almost always be guaranteed a very tight and liquid and massive volume market. So if I were to pull up right now on my trading platform, S&P options, you're going to find that it's one tick wide, the smallest increment possible at almost every strike, as is the future, of course. And you could almost buy or sell at any given time as much as you wanted to at a very small distance between the bid and ask. As you get into other products, then you can have really substantial reduction in liquidity. And for example, lumber or frozen orange juice futures or things like that. But even things like gasoline and heating oil, and to some degree, some of the metals at times, copper and some of the soft products, you have pretty liquid futures markets. But once you get into the option, and even in those, sometimes they're much less liquid, of course, than the underlying. But when you get into the options, they can become very illiquid, and you can find very large gaps between the bid and offer in specific options. And that's where, frankly, if you're going to trade those type of products, it's really important to understand equivalencies between options and the relationships between the options and the future, because there are going to be times that you're in a position and you want to trade out of it or manage the risk, and it might be more effective to trade a different option than the one that you have. and you can end up with a position where there's a spread or something that, or even something that's a straight out arbitrage where you have an equivalent position on, but it's not with the exact instrument you had before. And it's important to understand those relationships.
So I guess now that we have a better understanding of what options on futures are, and I know you kind of talked about this a little bit earlier today, but what are, I guess, some of the main differences between a option on future and a standard stock option?
Well, it really comes down, well, there are a couple of differences, actually. That's a good question as well. There are a couple of differences. First off, stocks, everything's unique a little bit. Every product has some uniqueness. Stocks have, you're not only trading the underlying, which is the stock itself, but stocks inherently have a dividend component, or may have a dividend component. And that's a bit of an unknown, because while a dividend might be, you may have a dividend projection, or you may have had past dividends, you don't necessarily know for sure what the future dividend is. But even if you did, that dividend is priced into the option. There's it's probably beyond the scope of this conversation, but there are times that you will exercise options early or be assigned options early because of the dividend. That is a part of the pricing, or a part of the unknown, I guess. But also the known dividend factor is part of the pricing. That's something that you don't have in futures options. Futures options don't have any type of a dividend component, and you're ending up with the futures product itself. The other main differences are that in a stock, when it's assigned or exercised, it does turn into stock. You either get a long or short stock as a result of a exercise or assignment. Whereas, and that's it. You have the underlying. Whereas, again, in a futures option, you end up with the futures contract. So when you exercise or get assigned, you end up with a futures contract, and now you've still got another derivative contract that you need to do something with. Okay. The two more things, actually. One is that options on stock very often do, investors use them, they do exercise them or get assigned, and they're okay with the stock and owning the stock or being short the stock in their portfolio. It's just part of the management of how they trade. Whereas speculators and even hedgers in the futures market rarely actually take delivery of the commodity that they're trading. So if you're trading corn and you've got an option on a corn future, you rarely will exercise that or get assigned and then take delivery or make delivery of the corn. You're going to trade out of it. So that's a lot different than in stock options. And the last one is an accounting issue. Stock options and futures options are quite different there, because in futures trading, you margin your futures trade. Okay, so essentially all you're putting up is the margin, and then you have to make the actual cash adjustments based on the variation, on the daily variation of the value of that futures contract. Whereas on the options on the futures, it's a lot more like stock options, where you actually pay outright for the option. And then if you're short, you still have a margin component on top of that. So it becomes a little more complex from an accounting perspective. They don't offset real time. So you can have a situation, for instance, where, let's just say, for instance, that you buy an option on a futures contract and you simultaneously sell a futures contract. Well, the adjustments on the fluctuation of the option price, of the futures price rather, is going to be treated differently from a cash perspective. So you can have cash management issues when trading futures options that you would not necessarily have when trading stock options. There are actually a couple of more significant differences between futures options and stock options. One deals with contract specs. So in stock options, you're always dealing with shares of stock. And in almost all cases, an options contract is for 100 shares of stock. And they're decimalized and they have the same values. But in futures options, each futures product has different specifications from the others. And in some cases, they're very strange numbers. They make sense, generally speaking, for reasons pertaining to that commodity. But for instance, in corn, it's 5,000 bushels of corn, and they trade in eighth-cent increments, and the tick size is $50 per point. But you can take another product that is entirely different. Gold is 100 ounces per contract. And I'm trying to think of another good example. You take something like heating oil, which is, I think, 42,000 gallons per contract. So it's everyone's different. You need to know the specifications, know the contract size and the tick sizes, and be sure that you are aware of that. So because they are different. The other difference has to do with the fact that when you're trading stock, it's fungible. Every contract is fungible, and every share of stock is fungible with one another. So if you're trading IBM options or Apple options or Google options, whatever your stock may be, if you trade a March contract, it settles into stock. And if you trade a June or July or any other contract, it also settles into the exact same stock. However, in futures options, you're trading on a specific futures contract. So a contract that settles into March futures is not fungible with a contract that settles into, let's say, July futures. Therefore, when you're trading calendar spreads or diagonals or things of that nature, you've got to realize that you're trading two separate different commodities, even if they are both, for instance, corn futures. It gets even a little trickier because you could, in something like the example of corn, be trading a month that's this year's crop versus a month that's next year's crop. And therefore, they're almost two different commodities altogether. So the relationships can be very different. Whereas in stocks, if you're trading a March stock option and you're trading June against it, it settles into the exact same stock. Or you can make adjustments as you're approaching expiration, the March expiration, you can adjust with a different month. And again, you're dealing with the same underlying. That's not the case necessarily in futures options.
And I guess to dig a little bit deeper into the differences, does hedging risk look different on stock options versus options on futures?
No, they're actually quite similar in that you get into, there are deltas, for instance, which there are a number of ways to define what a delta of an option is, but one of them is you can take options positions and essentially equate what the exposure is in the underlying product. So if you were to buy a certain number of calls, it would be the equivalent of owning a certain number of futures contracts. And same thing with options on stocks. If you bought a certain number of calls, it would be similar to owning a certain number of shares. And you can adjust your risk accordingly. Now, you have to be careful because those are not fixed numbers. Deltas change as other things change, as volatility changes, as the price changes. That's something called gamma that is basically the change of the delta. So it's not that simplistic, but they're managed in very similar ways between the two products. Again, with the exception of expiration can be a little bit different because of your underlying doesn't there's an extra step in that futures option.
So, why might a trader want to trade options on futures instead of a stock option?
Well, it's because it's though they're different products. So, stock options are just that. If you're trading stocks, then you would be trading stock options. But there are certain the futures products. Obviously, there are thousands and thousands and thousands of stocks, but they're all stocks, and you can trade options on most of them, or again, on thousands of them as well as individuals. But then there are certain products like the commodities, corn and gold and silver and crude oil and sugar and cotton. And, I'm only naming a few. In our CTA, we trade 29 different products in 8 sectors, but they're completely different than stocks. They're going to have complete different profiles, different risk profiles and so forth. And you've got a different, there's a different regulator. So from a professional perspective, you'll get some people who are distinctly different trading commodities and commodity options than stock and stock options. And it's just a complete different set of opportunity.
And I know you were saying that stock options and options on futures do have a lot of similarities, I guess. So can the trading strategies used for stock options also be applied to options on futures?
Sure, absolutely. As I said, with a few nuances of differences, they're the same. An option is an option is an option. And but you do have to understand those nuances, because they can, you can get yourself in trouble if you don't. But the strategies themselves, so call spreads, put spreads, ratio spreads, back spreads, straddles, strangles, time spreads, calendar spreads, all those things are the same on both. It's just a different underlying and a slightly different pricing model, again, primarily because of the dividends and interest rate chain considerations and nuances between the two products. Then going back to your question about why commodity versus stock options, there are some things in the futures options where there actually is not even an underlying that could be traded. So for an example would be something like the VIX contract. You have VIX futures and then options on the futures. But the VIX itself is an index, and it's a calculation. You can try to replicate it in ways, but it's not deliverable as a VIX product itself. It really is just a number. And you can say to a certain degree the same is true of other cash settled index products, or things that are very liquid. For instance, CME has a contract on real estate futures. Okay, a real estate futures contract. It's the Case-Shilling or Shiller, I think it's called Case-Shiller index, and it's an index on real estate prices. Well, real estate's extremely illiquid, of course. You really can't buy or sell a basket of the underlying to deliver. And so it's not a true hedge. It's really just a futures product of that index, which is not really investable. And then there's options on that as well. Whereas in the stocks, you do, in fact, I can't think of any exceptions. You do, in fact, have the underlying that you can trade it against. Not necessarily in stock indexes. You can have cash things like the OEX and SPX, and those are indexes which you can't deliver the actual underlying. You can replicate baskets, you can hedge risk, but you can't really deliver it against the contract.
So I know you were talking a little bit about the nuances that exist that come with the options on futures. Are there any specific trading strategies that are, I guess, are more specific to options on futures because of these nuances?
Not really. Not really. I'd have to think about that. Again, option strategy is option strategy, and all that is going to be very, very similar. There could be some very, very niche plays for a professional dealing with maybe some like exercise considerations and some ways to arb interest by kind of creating that cash flow situation I was talking about before. But that's going to be something that is very specialized, and very few traders per se will do as opportunity. It's really they're very similar in terms of why you would use them and how you would use them.
So I know we said we talk a little bit more about volatility. So here we are. So how does implied volatility vary across different strike prices and expiration dates for options on futures?
Okay, yeah, that's interesting. So just to explain what skew is. So well, to explain implied volatility and skew, basically in an option, there is a formula, there are models that are used to create theoretical values of options. And most of those values are known. For instance, what is the price of the underlying at the time of the trade? What is the strike price? What is the expiration date and time? Is it an American or European option? And the difference being that American options can be exercised at any time, and European only are exercised at expiration. Interest rates are kind of an unknown, but they can be hedged. So then it's a controlled unknown in terms of the future interest rate. But the one that's missing and is part of the formula is volatility. How volatile will that contract be between now and expiration? And that's an unknown. You can have history, you can have projections, but it's still an unknown. However, because in a liquid environment, if you have a liquid option that does trade, you know its current value. And therefore, it's quite a simple algebraic formula to determine what is the implied volatility that that option price has right now, because that's the only missing variable. And A, B, C, D, E, F equals G. Well, you know G because the option price is liquid and it is trading right now. So you can figure out what the implied volatility is. So in Black-Scholes model, for instance, which was is the most basic, and I don't know first per se, but was one of the first and well-known option pricing models, assumes that the implied volatility for that entire commodity or stock will be the same across the board, across all the strikes, because it assumes a normal distribution. But markets don't exhibit normal distribution. They have abnormal distributions, generally speaking, fat-tailed distributions, and they have a market skew, meaning the marketplace factors in a higher chance of either a big move to upside or a big move to the downside. And therefore, each strike trades as if it has a different implied volatility from one another. And that's what is considered market skew in an options market. Now, most people in the stock and bond world, but in the stock options world, think of it having a negative skew. In other words, puts and lower strikes are priced higher than calls or higher strikes. And the reason for that is that, generally speaking, there's more of a chance of a big move to the downside than a big move to the upside. And generally speaking, when you have a crash, if you will, or a panic situation on stocks, it's to the downside and not to the upside. And prices are, and therefore a call strike that's 5 strikes out of the money is going to be priced lower than a put strike that's 5 strikes out of the money. Okay, I hope that's clear. Now in the futures options, oh, go ahead.
No, go ahead. Sorry.
In the futures options, it's not quite that straightforward. In some cases, especially in the financial products, it exhibits a similar characteristic, but not always, but almost always. A similar characteristic where the lower strikes or the puts, out of the money puts, are priced higher than the calls. But in other products, like for instance, commodity products, agricultural products, it's the exact opposite. Calls are priced higher than puts. And I'd like to explain that in a way that I don't think too many people think about. And that is, where is the panic? So the fact of the matter is, in stocks, people are naturally long stocks. The world is long stocks. So the panic is on the downside. The panic is what hurts the people who are the natural holders or users of the product. And in stocks, for instance, that's clearly the downside. That's where the panic is going to be. But in something like food, in corn or soybeans, stuff like that, it's the opposite. Nobody's going to panic over food prices coming down. Or I shouldn't say nobody. the masses, the world is not going to go into a panic over prices of food getting cheap. But if there's a spike in food pricing, if there's some kind of a calamity, some kind of a disaster, and there's a crop failure and prices absolutely spike, and the world goes hungry or people go hungry and they can't eat, then of course there's a panic, right, on higher prices. So that's the way I see it, at least, that it's because the world is naturally short food, but the world is naturally long stocks. And therefore, where's the panic? And that's how it gets priced and why you have these skewed distributions the way they are. However, there are going to be times when something like a food product has more of a normal distribution, or even a negative skew position for some kind of reason, usually a supply and demand imbalance. But generally speaking, what I just said, is the case.
So I'm glad you brought in volatility skew. I think you actually might have summarized this question a little bit, but how does volatility skew determine market expectations and pricing of options?
Yeah, again, the pricing will be based on the skew because the implied volatility will be different at different extremes on the curve, okay, or different levels of strike pricing, and that will affect the pricing. Now, a lot of people think that they can take advantage of that skew in their favor, in terms of the fact that, let's just say, for example, in stocks, and in stocks or even options on stock index futures. So either way, if the underlying is something like a stock and it has a negative skew, then of course the puts are expensive and the calls are cheap. But they're really not. They're priced that way for a reason. But there are people who might think, that they can buy a put or a call cheap and sell a put expensive. And that's generally true if they have an absolute opinion about that and they end up being right. But there's no free lunch. The fact is, those people that are buying these or selling these, quote unquote, expensive puts because of the skew, there's a reason they're expensive. And when the market does crash and there is a panic, they're going to go up even more. Okay. So there are no free lunches. These things are priced properly for a reason. And if they're not, then the arbitrage world comes in pretty quickly and solves that issue. Not that they're always right, the arbs, and they could get burnt. Where it comes into play a little more on spreads. So if somebody were, to buy a put spread or sell a put spread, then yeah, there could in fact be some additional perceived edge or even real edge. That's up to that's the internal analysis that takes place when making that trade. But clearly the prices are affected by it, and the skew moves. The skew does change as well as the implied volatility, as well as the price of the underlying.
So I have a few final questions just to wrap up our
Yes,
conversation here today.
sure.
What are some of the most important lessons you've learned while working with derivatives in your career?
Oh, I'd say one would be, you've never seen everything that can happen. And, essentially anything can happen. And, I'm a big proponent of the black swan theories. So for those not familiar with the black swan, if you want a real understanding of it, this is a great book called The Black Swan, of course, by Nassim Taleb. That is what a black swan is, basically something that people don't think can exist or cannot predict in any way. And I often have people say, well, what do you think the next black swan is going to be? And well, by definition, there is no answer to that, because it's something that cannot be anticipated and expected. And in my trading career, I have traded through dozens and dozens of black swan events that just you could not see coming in any way, shape, or form. And you can try to factor in or account for every risk that's known, and there are some that are not. So that's the first thing that is a lesson. And therefore, I spoke early on about being short options versus long options. And as a result, in my options trading, I'm just about always at least net long options somewhere. In other words, even if they're far out of the money as protection, rarely am I net short options. And therefore, there's really not a case where you can, what we call blowout in the firm, where, you essentially the equivalent of going bankrupt, as a result of trading. So that's important. And that's that I'm cognizant of that all the time, that there are risks I don't know. Having said that, the other thing that's kept me in the business for as long as it did, and and made me successful throughout it, is again always managing what you do know and acknowledging there's still some things you don't know.
And I know we kind of talked about this very early in our conversation, but what advice would you pass along to somebody who's looking to get started in the options industry?
Yeah, today again, if you're talking about as a career in the options industry, you generally speaking, you have to go with a big firm. You have to have you have to have, if not a full tech knowledge, you have, if not full tech background and knowledge, you have to have some degree and some skills within technology, again, within the coding primarily. You're going to be working with the tech staff, with the quant developers. Option market making these days is a quantitative tool. I don't do that anymore. Option market making, as my commodity trading advisory firm, we are a directional trader. We use a lot of option analytics in our models, but we trade futures only and are directional. And being an options market maker at this point involves an infrastructure and an expense that is substantial. And it's not something that I want to do at this stage of my career. But those getting into it pretty much would need to be with a firm that has that backbone, that infrastructure, that the separate silos to a degree that would handle the risk management, the quant side, the technology, and it's just so fast. It's such a fast game that it's just an entirely different game. And to stand in front of a computer and try to be an options market maker as an individual is extraordinarily difficult. And I think it'd be very difficult to be successful at doing that. As an options trader, where you have opinions, you want to trade volatility, things of that nature, and a position-based environment, or with a position-based mentality, it can certainly be done. But it's tougher if you don't understand, how to use the technology to your advantage.
And you may know every week we choose a different topic for the show. So do you have any recommendations of a topic maybe we could cover just to learn a little bit more about options?
Yeah, one topic that I think is really interesting would be learning a bit about binary options. And binary options, until recently, have really been an illegal product in the US. They trade more on all. So what a binary option is really just, and there's no way really to sugarcoat it. It's a bet of with a binary answer, a yes or a no answer. So in other words, will the Dow Jones close higher today or lower today? And now it's 9:55 a.m. as we speak, and we can trade a binary option of that has a certain payoff if that is true versus false. So in other words, will today at market close, will the Dow Jones be higher or will it be lower? And you have a market around that, and if you're right, you get paid, and if you're wrong, you lose, and that's it. Okay, so generally speaking, those have existed on foreign exchanges and a lot of very shady places, and the regulators have come down heavy on those binary option operations. There's one exchange, Nadex, that's listed binary options years ago, and I think has been successful with it, but it's a very limited scope scope of product. And it's all got to be, of course, because it's regulated, they're financially driven products, as opposed to in the UK and different places, they might have things that are similar to binary options on an outcome of an election or an Academy Award winner or things like that. But where I think it's interesting is with the proliferation right now of sports betting and legal sports betting, I feel that sports bets are essentially binary options. And I think that I see a trend coming where the regulators are going to really start loosening this, because the opportunities within the exchanges that exist to essentially compete with that world is pretty big, and there will in fact be more market making, if you will. Whereas right now, if somebody's trading in those type of things or betting on those type of things in a sports book, there's edge that's insurmountable to actually make markets. But I think that in the future, you're going to see a lot more of that, and it will come in the form of a binary option. So if you get an expert on that, and that's not me, that might be a good topic.
Yeah, I think binary options is definitely something I'll have to do a little bit of research on myself.
Yeah,
But that's all I have for you today. So I want to thank you for coming on and
it was a
sharing.
pleasure being with you.
Yeah, so thank you for sharing your knowledge on options on futures. And for everyone watching, I'll see you all in the next episode.
Okay, thank you.
If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.